This is InvestTalk. Independent thinking, shared success.
Hi guys, great show. I was calling to see what you guys think of PayPal. I actually own at about $90 for average cost. I wanted to know if it's worth keeping or is it time to cut my losses. Thank you.
PayPal, ticker PYPL. I imagine is commonly known by most listeners. Even if you don't use PayPal directly, maybe you use Venmo. Venmo is owned by PayPal. And it got its start as a secure way to transact on the internet. One of its big partnerships originally was with eBay. Now it has grown. It has 500 million users, 500 million active accounts, that is. Not necessarily 500 million independent people, but active accounts. And it still is one of the most used payment processing companies. And their technology is everywhere. They moved over time into credit beyond just payment processing. Again, their Venmo segment has moved into crypto as well. And so they've been expanding. Over the past 52 weeks, they're up about 30%. 30%. Now, they're nowhere near their all-time high of about 310 and change per share. But this is a story of a company that is rebuilding. They have a new CEO in the past 16 months or so, who has, again, done enough to show stockholders, to show shareholders, that there is growth and improvements. Revenue has grown at 12% on an annualized basis over the past 6 years, though it has slowed down. Margins improving from a low of 8.9% in 2022, projected to be about 14.9% in fiscal year 25. Now, year to date, this company's struggling. And one of the reasons why is because the most recent quarterly performance missed, right? They had checkout growth at about 6% below the anticipated 7 to 8%. And that caused a pretty decent drop because of those fourth quarter 2024 earnings. But we own PayPal for Clients, and we didn't buy it, fortunately for us, around a 90% acquisition cost as you did. But you have to understand that PayPal is rebuilding. And so if you are a long-term focused investor like we are, then you see PayPal trading at only 15 times forward-looking earnings. Its 5-year average is 27 times. It's trading at 10 times cash flow, 2.5 times sales. It has a solid balance sheet. It's only got about $11 billion in debt. And over the past 3 years, they've been buying back shares. Everything has shown me over the past 12 months, generally, to be improving. Maybe not as quickly as some people would hope, but still improving. This is a rebuilding process. And if you're willing to stomach it, I think PayPal can be a solid choice. That's PayPal, ticker PYPL. Looks like we have our first live call, William in Phoenix, who has a question about, I don't know, you tell me.
Hi, International Seaways, I believe it's IISW. It's a oil freight company.
Okay, so do you own it? Are you looking to buy it, or?
I have a small position in it, yeah. I know it's very cyclical business, so.
Yeah, well, they tend to be, right? Because when you have international shipping and transportation, particularly within crude oil and energy, it's going to be entirely tied to demand, right? To petroleum demand, crude oil demand. And so it is going to move in a similar fashion with the way that the underlying commodity that it is shipping moves, right? It's down 1.69% today. We'll talk about what happened in the market today a little bit later. But oil didn't have a good day today. And it hasn't had a good day in quite some time. It's just about at $70 a barrel now. Now, this company is about a $1.8 billion market cap company, so it's a small cap company. It has a decent amount of debt for its size, around $665 million, but nothing too alarming, I would say. Now, over the past year, it's been down 28%. Again, we know that oil has been down as well. And in spite of that, right, you do see some pretty solid growth headed into 2023, at least. They haven't reported 2024 earnings, but headed into 2023, they had solid growth. Now, keeping that in mind, they're projected to decrease revenue from last year in 2024, and then again in 2025. So you have contracting revenue. In that time, you're also seeing margins slide pretty significantly. Now, they were negative during the pandemic. Again, not a lot of demand. But they had a net margin of 44.8% in 2022, 51.9 last year. That's supposed to slide to 46 this year and 37 the following year. Now, because of all this, because growth is falling off, because margins are contracting, you're seeing relative valuations fall as well, right? They're trading at a price to book of 1. They're trading at their asset value at this point. And so, when I look at this, I see, okay, it's probably a relatively safe dividend payer. It only pays 1.2% dividend yield, but the payout ratio is about 55. But the market is telling you, well, we think the price is a little high still. It's got about 8% short interest out there. Now, it recently reached a local low over the past 12 months of about $32 a share. It bounced from there, trying to find some support in the 35 range. I don't know if it will. There's a clear downtrend here. And so for this company, International Seaways, yes, it's cyclical. Maybe given that over time demand will come back, oil prices may be floated again. It could improve, but nothing is telling me from what I'm seeing that now is the time to enter. That's International Seaways. It took a while to find it, but we did. INSW. Looks like we got a phone call from Eric from California. Looks like we lost you for a sec, but I'm glad we have you back. You had a question about Walmart?
More about a core holding. So I had Walmart for 5-6 years. I thought it was a core holding, but I sold it earlier in the week because I felt like it was a little overvalued. I held it for a long time, but I'm having a little bit of FOMO now. I was wondering, what do you guys do in situations with, when you think you have a core holding, you sold out of it? Do you kind of, I don't really want to time it to get back in, but do you just keep it on your watch list, or do you kind of just let it go?
Yeah, well, that's a great question. I think it's very case dependent. When you're talking about something like Walmart, obviously one of the largest retailers in the world, right? They have in the past couple of years shifted beyond their brick and mortar stores, which have an extensive network globally, and taken a really hold of online retail as well. I know, at least through one of my credit cards, I get a Walmart Plus subscription. I've been using that more and more. I'm surprised that some of the same things that I used to buy on Amazon are also available there in similar price, similar quality. And so they've really grown to a massive behemoth. And so I think how you treat a company like that is probably fundamentally different from a small mid-cap company where you have an investment thesis that growth is going to come from this tiny segment, and maybe it doesn't meet your expectations and you get rid of it. Because Walmart's asset price, their stock price, the value of that company is more tied to the overall prevailing macro conditions of consumers than a really small company that is predicated upon one product being very successful. And so what I would say to you is think about the reason why you let it go. You thought it was maybe a little high in terms of its relative valuation. Now, they reported earnings today. It was disappointing. The stock's down 2.5%. Not just because of that, but because we've seen some poor macro data, which we'll dig into in a little bit, and what that could mean for consumers. And so I would say, it's good for these types of companies to always keep them on your mind. And if there comes a situation where the reason why you sold it has changed, right? Your feelings on it, your thoughts about it, what your investment thesis is towards it changes, I don't see any reason to not get back into it. But what you're saying is you're feeling a little FOMO, and that sounds a little emotional to me. So don't get back in it because of emotions. Get back in it because the reasons why you no longer wanted to hold it are no longer true. Thanks for the call.
For more insights and resources, visit us at InvestTalk.com.
Let's go to Mark from San Diego, who has a question about Oxy and CVX. You looking to buy one of them? You hold both of them? What's going on here?
Oh, I got some oil positions already, but I know oil's gone down, and I'm sick of adding. And I know Oxy is a lot smaller than Chevron, but I'd like to get your opinion on either one. Good time to add.
Well, let me ask you, if you already have oil positions, how much of your overall portfolio is oil and energy?
Oh, probably about maybe 10%.
10%. Okay, so nothing too crazy there. And then what are those names that you're holding?
Oh, I got like the big ETF, the Vanguard ones that do oil and energy.
Okay, yeah, that sounds good. What I was trying to get at is, do you hold any other individual oil companies that are similar to these? Because these are two pretty different names, right? Now, Occidental Petroleum, which is beloved by Warren Buffett. I think Berkshire owns something around 29% of the company. They've been buying it since 2019. Is a little bit different, right? They're one of the leaders in carbon capture and transitionary technology. Their balance sheet is not as strong. They're a $48 billion company with $27 billion in debt. They do pay a dividend. About 1.84% is their dividend yield. Now, their cash flow is a little stagnant, maybe towards the downside. Their profitability is falling. But they're going to get exposure to oil prices, right? Oil commodity. It's anytime you're buying, selling, moving, refining a commodity, your profits are based upon the price of that and the demand for that. And so the experience here between these two is pretty similar in terms of, how has the price moved in the past 3 months, right? Oxy's down 2%. CVX is down about 2.9%, just about the same. Now, on the other hand, CVX Chevron is a pretty darn large company, right? $286 billion market cap company. Their long-term debt's only about $24 billion. So a lot stronger balance sheet. Their free cash flow, a lot stronger. $21 billion is what their free cash flow is projected to be this year. Their dividend is double, about 4.4% versus that 1.84%. And they're a more established player. They're a rival with Exxon. They have an acquisition strategy. They don't really have as much exposure as Exxon to renewable technologies, and they don't have as much exposure to Occidental as renewable technologies. And so the question that you have to ask yourself is, well, do you want an established company, which you likely have a lot of exposure to within those ETFs? Or do you want to tilt more towards the growth side in Occidental, which has more investments in renewable technologies, carbon capture, and more of a transitionary focus? Honestly, just because these are two oil companies, two energy companies, they're kind of different. And so it's entirely, I'm trying to give you a little picture. Now, in terms of where the price of oil is, certainly bad day today. It's been down for a while. Demand just doesn't seem to be there. This administration really wants to pump up supply. I don't necessarily see anything, in the short to medium term that's going to make oil prices spike up. Certainly a conclusion to the Russia-Ukraine war would depress oil prices as well if people are allowed to start consuming Russian oil, and sanctions start to disappear. So I think it just comes to which one do you want? More transition focused or a big established name? Thanks for the call. Looks like we have another live call. Sherry from New York, who's asking about Ulta and ZBRA, listening on the podcast because it was recommended by a friend of hers who I think you should trust. How can I help you?
Yes, hi. Thank you for taking my call. I love your show, and I have two questions about two stocks.
Mm-hmm.
First one is ZBRA. It looks like after the earnings, the stock has been tanking. So is there like a good entry point now?
Okay, so let's take a look at ZBRA Technologies. We're actually talking about this, Justin and I were a couple days ago. And, I think ZBRA is a manufacturer of automatic identification data capture products. They help with mobile computers, barcodes, scanners, QR codes, all those sorts of things. And so most of their revenue comes from their enterprise visibility segment working business to business. And over the past 3 months, they're down about 20%. Year to date, they're down 19%. They recently reported earnings on the 13th of February. They're down 3% today. Now, they've started to do a shift more towards being focused on the software side, which could benefit them as a company. But all the trends I'm looking at here are negative, right? Cash flow is headed in the wrong direction. Profitability is headed in the wrong direction. Their valuation is still pretty high for a company whose growth is less than stellar and actually slipping. Right? They had a peak revenue in 2022 of $5.6 billion, then 4.59 the next year, then 4.9. It's projected to grow again, but over the past 6 years, they've only grown at about 2.3%. Now, their margins, all positive, but pretty volatile. 14.9% pandemic was where they had a local high. It's fallen since then. It's supposed to climb back a little bit. Now, in terms of debt, they don't have much on their balance sheet, only about $2.3 billion on a $16 billion market cap company. But frankly, I just think they're struggling. And so you're asking the question, is now a good entry point? Well, I mean, from a technical perspective, this thing's trying to find some support now, right? It dropped like a cliff from $420 per share in January down to about $311 now, $311 and change. And so this to me is the situation of don't catch a falling knife. So I wouldn't take this as an opportunity to enter at all whatsoever. If you want to keep it on your watch list, I think that's perfectly fine. But there is nothing from the momentum of this name as it's continuing to digest this new information that suggests to me that now's the time to buy. Thanks for the call. Another live call. Tom from Oregon, you're interested in learning my thoughts on stagflation. What is spurring this, Tom?
Oh, hey, Luke. Hey, first of all, love your show. I've been listening to it since the start of COVID, and those were crazy times. And, of course, they're crazy times now, so I just appreciate your show to keep a level head.
Well, thank you for that. You know, you realize as time goes on that they're all crazy. It's just crazy for different reasons.
Yeah. Well, in any case, yeah, I heard Justin briefly kind of talk about the potential for stagflation on the last show. I was trying to look into maybe what sectors, would be good to look at with the, potential stagflation. And, it mentioned healthcare, financials, and maybe some subsectors of REITs. But yeah, I was curious on your guys' thoughts, maybe what to look at if that does actually become more of a reality.
Yeah, so giving a little context to what stagflation is, in case anybody wasn't listening to the discussion yesterday. Stagflation is this concept from the 70s because of the oil supply shocks in 1973, where you have high inflation, you have high unemployment, and you have slow economic growth. Typically, what you see is the labor market and prices are push-pull, right? The primary force that drives inflation is actually us being paid more money, right? Yes, it's the government printing money, the government spending money, but if wages stopped growing, then a lot of the pressure on prices would stop as well. And so that's why the Fed looks at all these things and is a little worried when you see hotter wage growth than expected, because they think down the road, well, that may drive prices upward. And so here is a different situation where wages are not growing, wages are depressed. You can't get out of it by spending because economic growth is slow, unemployment is high, and inflation just doesn't budge. And so the worry stems from the fact that we are now seeing stickier inflation. We always thought it was stickier than a lot of people thought, but stickier inflation is now being shown by subsequent economic releases. And you have, from the fiscal impulse side, which has floated the market for a couple years, less spending, public job cuts, which could in turn slow growth with tariffs and all these things that could cause some bad side effects. And so, in times such as these, defensive sectors, consumer staples, healthcare, pharmaceuticals, utilities, one of the driving forces over the past year or so, right, has been the AI secular growth theme. Tech companies have a lot of money to burn. They are burning it on data centers. There's a demand for energy. So energy can be a good place to have, even in these types of situations. Gold. If there's a lot of uncertainty in the market, people will flush and flood towards safe haven assets. Not treasuries, because you have an issue with the U.S. economy, but they would flood to gold. So I think you're in the right spot when you're thinking about healthcare, when you're thinking about utilities, when you're thinking about staples, when you're thinking about gold. Those are some areas that maybe you want to increase your allocations towards, because in these high inflationary, low growth environments, those areas can benefit. Thanks for the call. Now, I mentioned it twice, but I'll mention it again. It is Friday. And on Friday, we'd like to take a little bit of time to run down a bit of benchmark numbers. So let me hit you with that list right now. The 2-year Treasury yield was at 4.194% today. For perspective, last week it was at 4.25. 30 weeks back, it was 3.882. And 68 weeks ago, it was 5.05. The 10-year Treasury yield was at 4.418% today. For perspective, last week it was 4.472. 26 weeks ago, it was 3.921. And 68 weeks back, it was 4.63%. Gold was at $2,941 per ounce today. We are getting ever closer to $3,000. Last week it was 2,883, and 67 weeks ago, when we all wish we had been buying gold, it was 1,935. Silver today was priced at $32.76 per ounce. Last week that number was $32.27, and 54 weeks ago it was at $22.80. Oil was selling for $70.57 per barrel today, an 18-cent decrease compared to last week. 22 weeks back, it was $67.79, and 64 weeks ago, it was $74.30. The national average for a gallon of regular gasoline is at $3.16, same as last week. 90 weeks ago, that number was $3.56, and 138 weeks ago, it was $4.25. In California, it was averaging $4.84 per gallon, a 30-cent increase, 30 cents over last week. 68 weeks ago, that number was $5.32, and 144 weeks back, that was $5.87. For comparison, this is the most depressing part for me to always read. For comparison, in North Carolina, gas was averaging $2.85 per gallon. That is $1.99 less per gallon than gas in California. Let's keep things moving and get to a fresh question from the comment section of our InvestTalk YouTube channel. I want to remind you, if you go over there and check out our videos, which present this show in a different format, and it's good to shake things up every now and then, but they present this show in a different format. So while you're over there, we have many videos, thousands of videos, I think. I've lost count. But on any of the videos, if you have any questions at all whatsoever that you would like us to address on the show, just drop it in the comment section. We check every single comment section. And this one came in from Taylor Mickelson, and it's on VXUS. It says, I'm looking to increase my foreign stock exposure. Is VXUS a good ETF to gain exposure, and is this a good time to get in? If you do get into an ETF like this, would you trim positions in single stocks like MTD and gold? Or is VXUS diversified enough where this could not impact your weightings for those single stocks? Let's take a look. VXUS is the Vanguard Total International Stock ETF. It offers a broad, inclusive portfolio of global stocks outside the US. Unlike some peer funds, it covers small caps in market-like proportions, which is to say a relatively small part of the portfolio. Essentially what they're doing is they're taking the FTSE, or as we in the industry call it FTSE, the FTSE Global Equity Index Series, which covers 98% of the investable market cap. And so taking a look at this, it is a passive fund, not just because it says it's passive, but 5 basis point expense ratio. It's got about 81 billion in assets under management. It is across sectors. It is across countries. You see here that there's a US listed here, and that's not because there are US companies in this portfolio, right? It's ex-US. But it's because this is looking at revenue. So even if you don't own, here's a fun fact for you, even if you don't own a single US stock, if you own a global stock that has no US companies, global ETF, no US companies, still 20% of the revenue comes to the United States. You can't really escape that US exposure in total. Now you see this comparison to the MSCI AC World ex-US IMI, that investable market index, right across the board, dialed in, again, passive index. Exactly as you'd expect it, small, medium, large caps. And so your main question is my weighting in MDT and gold going to go up astronomically because I hold this portfolio, this ETF? Well, if you're looking at home, if you're watching at home, I am highlighting how many holdings are in this portfolio. 8,469. 8,469. The largest stock is 2.5%. And so it is not materially going to increase your exposure to any singular stock unless maybe you're holding some of the top names. But still, even if you held Taiwan Semiconductor at 5%, well, now it's only 7.5% exposure. So this is a great fund. It's always a good time to get into the market as long as you're a long-term investor. So if you need that global exposure and you do not want to hold any US names, VXUS, cheap and solid.
Get ahead in your financial journey. Sign up for the KPP Premium Newsletter and receive tailored insights every week.
Let's go to Dan from Walnut Creek, who has a question about Palantir. Do you own it? Or are you looking to buy it?
Hi. Luke, thanks for taking my call. Yeah, I own a little bit, and I guess it's took kind of a little bit of a hit the last few days because there may be an issue with the government contract with all the cutbacks. And then I think it was a little bit overbought before that anyway. So I was wondering what your thoughts were on this.
Yeah, so Palantir, for those of you who do not know, is a big data analytics and AI solutions firm. And they primarily operate through government contracts, right? 55% of their contracts are government contracts. It has returned a significant clip in the past 3 months in the wake of the election. Obviously, Peter Thiel, one of the largest supporters of the current president, going back to his first time running for office. So solid connections there, especially for a company that is primarily majority of its revenue comes from government contracts. I think that's probably a good thing for them, right? I think it is unlikely, given Peter Thiel's connections to Elon Musk and the people who are trying to rein in government spending in certain areas are going to cut back on contracts with a company like Palantir. Now, over the past couple days, right, they're down 4.63% today, even though they're up 345% in the past year. Some of that could stem from the comments from the CEO of Palantir, or someone from the board who was talking about being able to sell some locked up shares, and that may have driven the price down a little bit. But, I tend to agree with you. It's incredibly expensive. It's trading at 232 times cash flow, 90 times sales, 190 times price to earnings. Certainly below the highs of 385 times price to earnings. But this is a company that has a consensus target price of 95, that consistently issues new shares up from 1.8 billion to 2.4 billion in the past 5 years. It's a massive company. It's 249 billion, that is. And so I'm not too concerned about the government contract side of it, because again, those connections run deep. But I would be a little bit concerned about the valuation here. Now, doesn't mean it can't continue to run up. We have seen this over and over again. Things trail and run and run and run, even at ridiculous valuations. But the risk still seems to me to be more to the downside. So I think I agree with you. It's a pretty expensive name. It's Palantir Technologies, ticker PLTR. Looks like we have yet another live call. Is this Will from San Diego again? Did we already talk to Will?
Yes. Not
Thanks
today.
for calling back. Oh, not today. We've had so many calls today because I asked and you guys answered. But you have a question about RILAs?
Yes, registered index-linked annuities. Is that a safe thing to invest in?
Okay, so there's never anything that's 100% safe to invest in. That is first and foremost. A RILA, a registered index-linked annuity, is a type of annuity that gives you market-linked growth, but generally has a cap, right, on the top side and protection on the downside. And so if you are pre-retiree or you are a retiree and you are looking for an instrument that can give you some of that market-like growth while also putting a hard cap on the amount you can grow, but also giving you some of that downside protection, again, it's not all perfect. There is some protection. It's not perfect. Then it could be something that you may be interested in investing in. Now, there are downsides, additional downsides. Again, it caps your growth. It's linked to the market, but not completely. They're expensive. Annuities can be expensive. And it's not completely risk-free. There are certainly risks involved. And so from my perspective, I generally stay away and advise away from annuities, because if you're looking for market-like growth with some downside hedging protection, any investment advisor or allocator could create a portfolio like that for you that is far cheaper than an annuity, that gives you a broader range of investment options. So it could be something that could work for you. I just think there are better options out there. Thanks for calling, Will, and enjoy your weekend. Well, we did it. We made it through the show without getting to a single talking point beyond our main focus point, because I asked for a bunch of calls and you guys responded, and I thank you for that. I'm Luke Ray. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify. And please be sure to leave a rate and review on iTunes. Remember, we can help you better understand your portfolio dynamics, calculate your investor risk number, build a full financial plan for you, and also help you optimize your 401k. It all starts at investtalk.com. Just click the free portfolio review button. Independent thinking, shared success. This is InvestTalk. Good night.